Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. February 3rd, 2026. This was not a quiet Tuesday. The Dow briefly tagged a fresh intraday record, just under 49,600, then reversed, closing off about 0.33%. The S&P 500 slipped just under 1%, and the Nasdaq dropped closer to 1.5%. On the surface, it looked like another tech-led pullback. Underneath, it was sharper. A rotation by fear session. The tape didn't sell the economy. It sold software duration. A fresh wave of AI disruption worries hit secular growth and workflow software, even as value, financials, energy, and old economy names quietly caught a bid. Tonight we'll unpack how that split opened up, why even the AI generals weren't safe, and where capital hid while software multiples got marked down. Look at the S&P 500 Heatmap, and the story jumps out: the big growth and tech squares, deep red. Semiconductors, cloud, software, Nvidia, Microsoft, Broadcom, AMD, Micron, all bleeding together. Even parts of healthcare flashed red around the crowded leaders, but the rest of the board wasn't collapsing. Energy majors like Exxon and Chevron glowed green. Consumer staples, Walmart, Procter, Pepsi, Coke were firmly bid. Big financials and Berkshire held that same green hue. Zoom out, and breadth was surprisingly solid. More S&P names were up than down, even while the cap-weighted index fell. This was concentrated pain in mega-cap tech and high multiple software, visually offset by a broad, steadier lift in value, defensives and old economy giants. That heat map wasn't random. It mapped a very deliberate money move. Capital came out of high multiple AI-sensitive tech and communication services, semis, cloud, long-duration software. Classic secular growth became the funding source for everything else. On the other side of the trade, energy topped the leaderboard. Integrated majors drew in buyers looking for real asset exposure and steady dividends. Consumer staples pulled in flows from investors who wanted visibility and pricing power when the macro picture feels fuzzy. Financials, big banks, regionals, insurers were broadly green, helped by easier yields and a slightly steeper curve. Industrials and domestically focused small caps kept grinding higher, signaling this wasn't a macro scare. It was a factor rotation. Put simply, the market still wanted equities. It just wanted balance sheets, cash flow, and old economy leverage to AI, not frothy software promises. Underneath that rotation sat a very specific anxiety. Anthropic rolled out new agentic automation tools aimed squarely at legal and professional services. That's not just another model release. It points AI directly at the high-margin workflows that a lot of software and advisory names have been monetizing for years. On desks, the phrase you heard was future spread product. The fear that certain workflow platforms get squeezed, AI infrastructure on one side, end clients on the other. Gartner's collapse turned into the day's tell for that idea. A brutal markdown in how the market prices research and advisory leverage to software budgets. So the tension isn't about the economy falling apart. It's about whether long-duration software and secular growth can still defend their margins, now that AI is a direct competitor, not just a tailwind. Around all of that, the rumor mill stayed busy. One thread on trading floors, talk of strain between Nvidia and OpenAI. Headlines and chatter suggested OpenAI could be diversifying hardware and cloud partners. Nothing looked like a confirmed fundamental break, but the narrative alone was enough for some desks to question Nvidia's AI monopoly storyline. In parallel, silver's wild rebound after an extraordinary prior crash had traders arguing in real time. Was today's bounce in spot silver and SLV just a short squeeze snapback, or the start of a more volatile, structurally different metals regime? Both stories lived in the gray zone chatter, not hard data. But together, they pushed desks to rethink how concentrated their AI and metals bets had become, and where tail risk might really be hiding. AMD just posted better than expected earnings, and the stock dropped. On the surface, the quarter was strong: record revenue, solid data center growth, clear progress in AI chips. By normal standards, that's a win. But the market wasn't trading the quarter. It was trading expectations. Guidance came in solid, not spectacular. And for a stock that's been priced for near-perfect execution, solid just wasn't enough. At the same time, today's tape punished anything tied to long-duration tech. Traders are starting to ask whether AI demand shows up fast enough, and whether margins get squeezed before revenues really scale. Retail traders called it priced in. Some bought the dip, others shrugged and said this is what happens when great results meet even greater expectations. So this wasn't about AMD failing. It was about the bar being set extremely high. The real question now isn't what AMD earned last quarter, it's how patient the market's willing to be from here. Let's start the single stock run-through with where AI still works. Palantir ripped higher after a military-grade AI earnings beat. Better than expected profit, solid guidance, reinforced demand across government and commercial clients, all in one tape. What mattered wasn't just the pop. It was the context. On a day when software and secular growth got repriced lower, Palantir printed bright green. That told you the market is drawing a hard line. AI names that can show real earnings and improving cash flow still get paid. Names leaning only on narrative and multiple expansion do not. Palantir became the poster child for this new phase of the AI trade. Fundamentals first, story second. On the other side of the AI ledger sat Nvidia. The stock fell close to 3% as funds degrossed high beta AI and software. For many, Nvidia wasn't the problem, it was the positioning. It's the most liquid proxy for the AI build-out, and on days like this, that makes it a funding source. Chatter about cooler relations with OpenAI only added narrative weight. Even if the hard facts are still fuzzy, semis across the board felt that gravity. But the real signal was simpler. If the market's willing to hit Nvidia on a broadly green breath day, it's telling you AI leaders are no longer untouchable. They have to re-earn their multiples every quarter. Microsoft told a similar story, but from the software and cloud side, the stock lost almost 3% as investors kept digesting earnings and rethinking how much premium they're willing to pay for its AI and cloud exposure. Competition is fierce across platforms and price points. Desk Talk focused on whether AI benefits end up more widely distributed across the ecosystem than early bulls assumed. Because Microsoft is such a heavyweight in both the Dow and the S&P, its slide became a major drag on the indices. More importantly, it signaled that even the highest quality AI franchises aren't immune when the market's in valuation compression mode. While software derated, old economy retail quietly made history. Walmart became the first traditional retailer to cross the $1 trillion market cap line. On a down day for the big indices, that milestone mattered both symbolically and practically. The stock climbed as investors looked for companies with real pricing power, strong omni-channel execution, and exposure to everyday spending, not just digital ads or enterprise licenses. In a session defined by AI anxiety and software repricing, Walmart stood out as the market's vote for real-world scale and durable margins. It turned into a key counterweight to tech stress on the consumer side of the ledger. Financials and JPMorgan in particular told you what this day was and what it wasn't. JPM traded higher alongside big banks, regionals, and insurers. Easing treasury yields and a slightly steeper curve helped sentiment on net interest margins and balance sheet risk. If this had been a true macro scare, banks would not have looked this constructive. Instead, their strength showed that capital leaving mega-cap tech found a home in financials. JPM stayed the market's primary read on U.S. financial system health, and its green tape underlined that Tuesday's move was rotation and repricing, not a funding stress episode. Energy also stepped into the leadership role, with Exxon Mobil front and center. The stock rallied as investors rotated toward hard asset exposure and dependable dividends. That move got an extra nudge from geopolitics. Crude oil rose roughly 2.5% after the U.S. Navy shot down an Iranian drone in the Arabian Sea. Gold saw a quick reversal, and the broader message was clear: geopolitical risk premiums are creeping back into pricing. For portfolio builders trying to offset software and AI volatility, Exxon and the broader energy complex became a natural hedge: tangible assets, global scale, and cash returns, instead of long-dated software cash flows that may now be in AI's crosshairs. So where does this leave the next few sessions? With the January jobs report delayed by the government shutdown, the market's flying partly blind on the labor side. That raises the stakes for the coming macro and inflation data cluster later this month. In the gap, earnings take center stage. Traders are stress testing which companies really own pricing power and margin resilience when AI can undercut traditional fee pools. Expect risk to stay tight in AI and long-duration software, with more willingness to add selectively to value, banks, hard assets, and AI names that already turn buzz into cash flow. AI hasn't stopped being a growth engine. It's just become a margin weapon too. And the market is busy repricing who's holding the blade versus who's on the wrong side of it. To wrap it up, February 3rd drew a clear line in the sand. Secular growth and long-duration software took the hit. Value, banks, energy, and a handful of cash-generating AI names picked up the slack. The AI story didn't die today, it matured. From euphoria to earnings discipline, from unlimited runway to prove it every quarter, with jobs data delayed and a heavy macro and earnings slate ahead. This rotation by fear may not be the last factor shock we see. We'll be watching how far investors keep pushing this re-ranking of pricing power and when, or if, they're ready to lean back into the very growth engines they just used as their liquidity source. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.